It's an honor to have Ann Sonders back with us, Managing Director and Chief Investment Strategist at Charles Schwab. Ann, you were last with us on November 23rd, and if memory serves, which it typically does with me, you were quite constructive on things, and it's played out almost to a T. So before we look forward, because, this is really what we want to focus on, sort of the look forward for the second half of the year. Let's take sort of a look back in terms of what you thought would happen and what's transpired over the last, 6 or 7 months since you last joined.
Yeah. So when we put our full year outlook to bed in November of last year, it was a fairly constructive outlook, and that was actually not based on what at the time was an assumption of an aggressive move by the Fed to start cutting rates in March and cut by 6 to 7 times. We actually were pretty vocal about the market having gotten way over its skis in terms of that aggressive an assumption for rate cuts, and in fact said that if that were to have panned out, that wouldn't be a good thing from a market perspective because it would probably suggest much greater deterioration in the economy, not just sort of immaculate disinflation. And ultimately, the market came around to what the Fed was telegraphing and what the data was telegraphing, which is they had their eye more on the escalator, not the elevator, in terms of when to shift to easier policy. And what we have also experienced, at least in the first half of the year, as we've been writing about and speaking about, is a tale of two markets. You've had what's happened at the index level, courtesy of the concentration up the cap spectrum, maybe until the past week or so, and much more churn and rotation and even turmoil under the surface, which is where that connectivity is to all the macro uncertainties with which we're still dealing: inflation and Fed policy and geopolitics and the election. Now, in the aftermath of the better CPI report, you've seen this huge rotation down the cap spectrum, which I think in general has legs, but I wouldn't expect it to be as robust a leadership change as what we've seen in the past week and a half. I think it probably continues to happen, but in fits and starts.
A lot of things have surprised me since the fall of last year. Is there anything in particular that stands out to you in terms of, wow, I didn't see that coming, or seemingly that came out of nowhere? Thoughts on that?
The dramatic underperformance outside of the mega cap names, again, until recently. So there's data I highlight in a table that goes on my Twitter feed every morning, which looks at the maximum drawdown at the index level for the major indexes: S&P, Nasdaq, Russell 2000, and those have been very mild at the index level. Using the Nasdaq as an example, at the index level, just a 7% maximum drawdown from the peak to the worst part of the trough. But at the average member level, the maximum drawdown is negative 40% in the case of the Nasdaq. That's obviously deep bear market kind of weakness. And having a somewhat of a spread there where you have the cap weighted indexes flattered by some of the mega cap names wasn't a big surprise. It was just how dramatic the underperformance was from a maximum drawdown at the average member level, or the percentage of stocks within any of those cap weighted indexes outperforming the indexes themselves. So it was the drama in the rest of the market and the weakness that went beyond what we expected heading into the year.
Yeah, what's remarkable is, not the relative strength, the absolute strength of the S&P 500 and obviously the Nasdaq as well. Seemingly, flying in the face of what have been a lot of headwinds and have been a lot of unforeseen, geopolitical stuff, which I know you can't put those into your projections and your prognostications, but they've been out there. So, I've been surprised at just sort of the lower left, upper right, slow and steady wins the race up until recently, at least in these broader indices. Thoughts on
But
that?
that's only at the index
Yeah,
level.
that's right. Exactly.
So it's only courtesy of the mega cap names, again, until, call it, the last week and a half. So for people who are flummoxed at the resilience in the face, to your point, of all of these uncertainties, all you have to do is look under the surface of the index level changes, and you do see a reflection in terms of market behavior, where leadership has resided, where it hasn't. The average member maximum drawdown, again, of negative 40% in the case of the Nasdaq, and that is where I think you have seen this greater connectivity to all of these macro uncertainties. You just don't notice it if you're only looking at the index level changes because they have been flattered until recently by the mega cap names. The other interesting thing that I find anecdotally when talking to many of our investors is there's some conflating that has been done on whether it's the Magnificent Seven or the largest 10 stocks, whatever subset you want to look at in terms of leadership, as if the only way to have done well in the market this year was to be in those names. Well, if you're an institution and you're benchmarked to these cap weighted indexes, yes, you need to be in those names, but it's really the multiplier of their cap that has meant they're the biggest contributors to S&P performance or to Nasdaq performance. They're not the best performing stocks in either of those indexes. Only one of the Magnificent Seven is it in the top 10 list of best performers year to date for the S&P. None of them are in the top 10 for best performers in the Nasdaq. In the case of the Nasdaq, none of the best 10 performers are even household names. They're all kind of mid-cap, somewhat unknown names. In the case of the S&P 500, 2 of the 10 best performing stocks are utility stocks. You got a healthcare stock in there. GE is on the list. So I think there's this misperception that for individual investors that they're not mutual funds, they're not benchmarked to the S&P, that the only way to have found good stocks or to have some decent performance is to only be in those names. That's actually not the case. There have been plenty of opportunities outside of those names. It's just the multiplier of their cap that means they're the largest contributors to performance. They're not the best performers from a price perspective.
So that answer, the question and the subsequent answer sets me up perfectly for your second half outlook. But before we get to that, I want to ask you this. And, in your storied career, have you seen any parallels to what we're seeing now, just in terms of the math surrounding what you were just explaining?
So in terms of the 10 largest stocks as a weight within the S&P, it recently hit a peak of 38%. And the last time it was similarly high was in the 1970s when it hit about 35%. I think even though we don't have the precise data, you can kind of mock it up a little bit. And I believe it was a period in the early 1930s, similarly high. Of course, the market landscape was entirely different then. There just simply weren't anywhere near the same number of publicly traded stocks. So I don't know that that's an apt comparison, but that concentration really did hit an extreme, not just based on a metric like 10 largest stocks as a share of the overall S&P or the overall Nasdaq, but the very, very low percentage of the rest of the market that had been outperforming the index itself. So it was sort of the bookends that represented the extreme. There have been plenty of times in history where large cap stocks do particularly well and that flatters the cap weighted indexes. It's at the other end of the spectrum when you have such dramatic underperformance that the concentration risk becomes more acute. And what's really notable, and this is unprecedented, in the past kind of month and a half, and my friends at Sentiment Trader, which I love their research, they have phenomenal databases. They've been talking about this oppositional deviant or defiant disorder, ODD, which is a disorder that can affect children, actual human children, but they applied it as an analogy to the stock market on a rolling kind of 1 month look back. And it just looks at on a individual day-to-day basis what the indexes are doing versus what underlying breadth is doing as measured by net advances declines, and it's been in both directions. So on almost every single day when you would have a strong day from an index perspective, you would have much weaker breadth as measured by AD, and on days where you had much weaker index performance, you had much stronger breadth. The extreme of that is unlike anything we've seen in the history of that kind of data. And that in the past, when we've had, though not the same extremes, but somewhat similar drama there, that has been to the benefit of equal weight relative to cap weight. It's provided an opportunity for stock pickers, for active to live on a more level playing field with passive, and maybe a week and a half doesn't a trend make yet, but it's something worth keeping an eye on.
Yeah, and that's what I was going to say. I mean, it seems like that's the battleground between active and passive investing and sort of that push me, pull you stuff, which, passive seemingly has been winning for quite some time, but every once
Sure
in a
has.
while, active sort of rears its head and tries to participate. And we'll see how the second half plays out, which is what I want to talk about now, sort of your second half outlook and, how you're sort of navigating what we've seen, because you have to take that into consideration, and what you think we're going to see. Obviously, nobody has a crystal ball, but you do it extraordinarily well. So talk about your second half outlook.
I think a lot of it is tied up somewhat obviously, I guess, to Fed policy and of course their reaction function and what they're reaction to, which is now a combination of both the inflation side of their mandate and the labor market side of their mandate. And it wasn't just the better than expected CPI report that really caused a honing in on September as the likely start point. But the recent loosening in the labor market, the move up in the unemployment rate from a cycle low of 3.4% up to now 4.1%. I think it's the combination that at this point anyway, absent additional data on both fronts between now and the September FOMC meeting that has the market kind of gelling on a September start. So I think that and then related, of course, moves in longer term bond yields that I think will be in the driver's seat of what the equity market does. Back to the active versus passive, as I said, I think there are opportunities for continued bouts of outperformance of equal weight, of active performing better, or at least on a more level playing field with passive for it being more of a stock pickers market. We've had the return of the risk-free rate that has brought correlations down and dispersion has widened, and that does suggest a better backdrop for the so-called stock pickers out there. But I will say that at least at this point, looking into the second half of the year, there might be that sort of itch not just to go outside of the mega cap names to look for opportunities down the cap spectrum into areas that have underperformed, to maybe loosen the reins a little bit on quality characteristics, because there are times where you want to go down the quality spectrum. That's where the leverage to a turn up in the economy is to a significant turn up in earnings. I'm just not sure we're quite there yet. That's usually what happens when you're coming out of a recession and you're starting to price in the next expansion phase in the economy, going down into the non-profitable area, maybe even to the zombie companies if you're in a significant cutting part of the cycle. I think there are opportunities down the cap spectrum in areas that have been underappreciated, but I would stay up in quality from a factor perspective. I don't think this is the time to sacrifice that quality angle.
It makes sense. And then I guess to a certain extent, you have to have a view on, and I'm not going to pretend that I know. I think I have an understanding, but are we early cycle or are we late cycle? Because I think to the extent, well, I know you're
Yes,
laughing because you can talk to 10 different people in our world and you're probably going to get, some sort of variation of 10 different answers. So I'm curious as to your thoughts.
right. Well, this has been a unique cycle, and that's the ultimate understatement. That should elicit nothing more than, well, duh, Lizanne. It's obviously been a unique cycle, but it's the rolling nature of this cycle in terms of not that anybody wants to rehash or relive the last 4 years, but if you go back to the early surge stage in the economy driven by the massive stimulus in 2020, all of that stimulus and the demand associated with it was funneled into the good side of the economy. That's where the burst of growth came from. And it left services in the dust because they weren't open and accessible to anybody. But then you went into recessions, actual recessions in manufacturing and housing related, and a lot of stay at home beneficiaries on the consumer product side of things. So you had mini recessions. It was enough to take GDP into negative territory for the entire first half of 2022, but you had the offsetting strength at that same time on the services side. Services is a larger employer, helping to explain why the labor market stayed afloat. It happened, the roll through happened in inflation. The initial burst in inflation was on the good side of inflation. Services was much weaker. We then rolled into deflation in many of those goods categories, but we've had the later pickup on the services side in inflation. And now that's starting to roll over. So we've already had late cycle and then mini recessions in some of those areas and the hope for start to a new cycle. Yet we haven't had the cycle yet occur in any significant degree in terms of the downside on the services side or in the labor market. So I think we could avoid an NBER declared recession if we continue to see a roll through, but I think that's the way we have to think about this unique cycle, is that it's come in fits and starts in different segments of the economy at different times, as opposed to either the bottom falls out all at once, like was the case in 2008, and or then the recovery happened all at once and across segments of the economy. This has been much more segmented, and we still have these extreme bifurcations in the market and cross currents. And it just requires, I think, a more nuanced type of analysis to judge where we are in the cycle. This is a today's orange compared to history's apples.
No, listen, and I struggle with it all the time. And it's interesting, you talk about rolling recessions and statistically, what I find fascinating, if you ever want proof positive that the stock market is not the economy, and we can talk about it till we're blue in the face, but, it comes in the form of the approval rating of this administration in terms of the economy, which is probably at historic lows. The flip side of which is stock market until the last couple of days, at least, are at historic highs. So there's a disconnect. So what's fascinating to me is, if you were to poll 100 people in the middle of Times Square and ask them, are we in a recession or not? My sense is a larger percentage than you would realize think that we probably are. And that speaks to, I guess perception is reality. So I guess my question to you is, how do you sort of game out? Because in any second half of a presidential cycle, and I'm not asking you to play politics, but you sort of have to think about, okay, in a continuation of a Biden administration, what does this look like? If former President Trump were elected, what does it look like? Does it move the needle, or is it just on the margins, not all that interesting?
I think it's more on the margins, and it tends to manifest itself in sector rotations and volatility at the sector level, especially when you get closer to the election. I'm not just talking about this election year. I'm talking about past election years where there are policy proposals by both candidates, and that might move the needle based on polling results on sectors that are seen as benefiting from one candidate versus another. But the real important kind of point that we always try to make is be really careful about trading around these kind of narratives at the broad market level, at the sector level. And one example that I think is really instructive, and I'm not playing politics here. You know me. I'm data based. I'm fact based.
Absolutely.
I'm not bombastic, especially as it relates to the emotional year that this is from an election perspective. But let's just use the energy sector as maybe what would appear to be kind of an obvious sector that is seen to be a beneficiary under Trump and not under Biden. If we're talking about the traditional energy sector dominated by fossil fuel companies and the big major oil and gas companies and the drillers, because that's the S&P 500 energy sector. If somebody at the beginning of the Trump administration back in, well, we'll do inauguration day to inauguration day. One might assume, oh, well, traditional energy will do incredibly well under Trump and will do incredibly poorly under Biden. The exact opposite actually has happened. Under the Trump administration for 4 years, inauguration day to inauguration day, the energy sector was the worst performing sector of all 11. Since Biden's inauguration day, 3.5 years ago, the energy sector is the best performing sector, even better than technology. I'm just using that as an example, but really to point out not that perceptions around candidates are wrong. There's so many other forces that impact what goes on with markets, within sectors that, especially during election years, we tend to think that there is an incredible tie-in and connectivity and thread between one candidate versus another and their proposals and how the market is going to do. If anything, it works in the opposite direction. It's what's going on in the economy that tends to impact elections more than the other way around. And I think that sometimes gets lost in the discussion when you're in the throes of an election year.
I'm so happy you brought that up because I've said it a number of times. Said it on Fast Money. I'll say it here. What I've said years ago and what I'll say now, somewhat counterintuitively, the best thing that happened to the energy sector was the Biden administration. And you just sort of talked about it in real terms, but you can look at the stocks and it's playing out. And I don't think anybody would have sort of anticipated that. So I'm glad you brought it up. The other thing that you have to talk about is, market sentiment, right? Like what are we looking at now versus what you've seen historically? Because quite frankly, I'm hard pressed to figure it out. I know what the sentiment is around the economy, obviously. I'm not quite sure what the sentiment is around the market right now. So maybe speak to that.
So I think it's really mixed right now. It's another place where there are cross currents. But let me just touch quickly on sentiment around the economy because I'm glad you brought that up. I think to your point about man on the street interview in Times Square and the percentage of people that might say, okay, I think we're in a recession. I think what plagues consumers most right now is the inflation backdrop. And it's not based on the average, person in Times Square answering your or my question on this is not going to talk in the kind of details that we live, eat, and breathe every day of headline inflation versus core inflation, super core services, X housing, and the month over month changes and how that maps to the year over year changes and how CPI and PPI data map to PCE, which is the Fed's preferred measure, and the base effects, blah, 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 blah. The consumer thinks I'm paying a lot more for stuff than I was in 2019 pre-pandemic, period, end of story. And it's part of why University of Michigan's consumer sentiment has been weaker than Conference Board's consumer confidence because consumer sentiment tends to be biased more by what's going on in the inflation environment, where consumer confidence is biased more by what's going on in the labor market, simply based on the questions that are asked. So I think that's something that needs to be understood on the consumer side of things as it relates to confidence about the economy. In terms of the stock market, we've also had real divergences in terms of attitudinal measures of sentiment and behavioral measures of sentiment. And that's just not a new phenomenon. That goes back really to the bear market period in 2022. I always use this as an example of don't just listen to what investors are saying with regard to their view on the market. You got to watch what they're doing too. So when we had the first big whoosh down in the middle part of 2022, you hit a point leading into the big weakness in June where AAII, American Association of Individual Investors, got to a record high percentage of bears and a record low percentage of bulls, a record including the 2000 period, the global financial crisis in '08, even greater than in the aftermath of the crash of '87. But at that same time, using AAII's actual data, because they track the equity exposure of their same members that are polled for the weekly attitudinal measure of sentiment, you were only about a percentage point off of all-time highs in terms of equity exposure. So, answer the survey, do you like the market? The answer was no, it's terrible because the market was sort of imploding at that point. They hadn't really done anything about it. Fast forward to the October low in 2022, the indexes had taken out the June lows. Better breadth was bubbling up under the surface. That was a good backdrop. But you also had, to use a technical term, more of the puke phase in sentiment, in that you had the behavioral measures sort of match the attitudinal measures. Fast forward to this year's period, we've had instances where you see a big spike in bearishness, and it happens fairly quickly, even with only a mild, mid-single digit kind of pullback in the market. And quickly you see the attitudinal measures of sentiment move to the bearish end of the spectrum, but you don't see it as quickly in those behavioral measures, whether it's a put-call ratio or fund flows, or maybe as a proxy for sentiment, the VIX as a measure of implied volatility. So not that sentiment is ever a perfect contrarian indicator. It's not a good market timing tool, but if you want to get a sense of, okay, this is a setup for a contrarian move, you tend to want to see both the attitudinal and behavioral measures of sentiment kind of look the same. And that's where there have continued to be a lot of cross currents this
Well,
year.
you're clearly reading my mind because I'll go back to 22 with you and I will say, as horrible as I've been for a long period of time in terms of just the broader market, 2022 made a lot of sense to me. And the two times that I said, you know what, here's an opportunity to be bullish was, as you said, in June of that year. By the way, when the VIX, I think it was June 17th, I'd have to go back and look, traded up to about 34.5 or so, which is levels we hadn't seen for quite some time. And obviously, you just mentioned the sentiment around the market. that seemed to be a logical place to say, okay, this is a tradable bottom. And it happened again in October with the VIX again trading back to those levels. We haven't seen anything remotely close to the VIX since then. I think maybe we got to 22 or something in October of last year. And again, I'm not asking you to trade the VIX, but what does your instinct suggest that's happening around the dampening of volatility now for quite some time?
So, it's in large part due to the flattering up the cap spectrum of these cap weighted indexes, and that has helped contribute to keeping volatility low. That said, given that we're talking about second half outlook, at some point, the path of least resistance for volatility goes higher. And could the election represent one of the catalysts for that? Yeah, I think that's a distinct possibility. It's hard to judge exactly when that happens. Volatility can be suppressed and can stay suppressed for an extended period of time. A former colleague of mine, who you probably know, Randy Frederick, who's an expert on this stuff, would often say if he were asked a direct question around things like trading the VIX, and he would usually preface his comments with, "I wouldn't suggest anybody try to do it, but if you insist," instead of trying to nail the point at which the VIX goes from a very suppressed reading and has a spike higher, you almost wanna just wait for the spike to happen and then kinda short it in the spike, because you don't tend to go through elongated spans of time where you're at extremely elevated. That tends to be much shorter period of time, where you can go through very extended periods of time with low volatility, and trying to sort of trade the inflection point and the bottom is much trickier than kind of playing it, and I hate that term, in the opposite direction of waiting for the spike and then, putting on trades that tie to volatility, then easing off those spike levels.
And I know, listen,
All that said, I'm not anything resembling an expert in trading the VIX, so that was a very long answer
no,
for
no, but
somebody that
listen, but it's always fascinating to hear your thoughts on things because I respect your opinion. And I'll say this: you're spot on. Number one, I know Randy's work. Number two, but what's interesting and about in terms of market, when you're just looking at the data, you can take emotion out of the equation, and you do it extraordinarily well. Most people cannot do that. So
they can't.
we can sit here and say, okay, if the VIX were to get back to the aforementioned 34 and a half, it's going to look scary as shit, but there's going to be your
Sure is.
opportunity. And you can lay that out for people. But what we've seen time and time again is it's always for reasons that you never foresaw. And it's always going to look a lot scarier than you thought. But to your point, if you can sort of take a step back and say, okay, here's not my opportunity to get out, but to get into things, we're much better served, which leads me to my next question in terms of, what are the I guess not necessarily sectors, but areas of opportunity in the second half. We've obviously seen for the first time in about a year and a half, the small caps, which everybody is talking about now, have had a remarkable performance. Banks, to me at least, somewhat counterintuitively, although it makes sense on the margins, have obviously done very well. What are your thoughts in terms of some of the opportunities that you're seeing?
I think the opportunities are more at the factor level than they are at the sector, or call it style box level. I think this is not a market environment where you can or should take a monolithic approach. When I'm asked, "What do you think about small caps?" I always, kind of have the smile in the back
Right.
of my head of, "Well, what
What are you
small
talking
caps?"
about? Right. 100%.
The Russell 2000 has what, I don't know, 1,800 and some odd stocks in it. It's not monolithic, and we have a market backdrop that has lower correlations and wider dispersion. If you look at the Russell 2000 and just go over the trailing 1 year period of time, there is a huge spread just between the profitable stocks within the Russell 2000 and the non-profitable stocks. You can do the same thing with the zombie companies versus the non-zombie companies, or the high interest coverage companies versus the low interest coverage companies. And that's not just within an index like the Russell 2000. You can do it within the S&P. Look at strong balance sheet companies versus weak balance sheet companies, interest coverage ratios. Again, you can apply it to at the sector level within, the high flying sectors like tech or communication services. There's a huge range in terms of performance. And a lot of it is on those, strength of balance sheet, profitability, interest coverage, free cash flow. And so I think you're doing yourself a disservice if you think a monolithic approach of I'll just be either in or out of tech or in or out of, financials or energy. Leadership has been much more consistent at that factor level, whether it's profitability based factors or valuation based factors or cash flow based factors, and even momentum, which we especially these days we talk a lot about because as a factor, it has dominated performance. And in fact, it's dominated performance to a similar degree as what we saw in the late 90s into the peak in 2000. But here's my view on momentum as a factor. It is a factor. It's on anybody's list, Bloomberg or otherwise, of factors. You can screen for it, but it's not really a fundamental factor. All momentum working means is that stocks that have been working continue to work. It doesn't say anything about the fundamentals of what's working. It just says that what's working continues to work. So the reason why I bring that up is when momentum as a factor was dominant in the late 90s, the fundamental factor that was most highly correlated to momentum was negative earnings. In other words, the momentum was in the crap in the late 1990s. Now it's profitability that is most highly correlated to momentum. It's high free cash flow, it's strong return on equity. So the momentum has been in areas of better fundamentals. And I think that's an important distinction. When people hear momentum, sometimes they automatically think, oh, it's the high beta tech stocks. No, momentum is just a concept. It's like defensive. Defensive people think automatically it's, utility stocks or consumer staple stocks. Well, in the early part of the pandemic, the defensives were the big tech stocks because they represented the only ecosystem in which we were all living. That made them defensive. During last year's banking crisis, they became defensive because they didn't have to rely on the banking system. They weren't at the mercy of the turmoil that we were seeing there. That made them defensive, even though they were not utility stocks. They were not consumer staples. So we have to sometimes get out of our own mindset of what some of these terms mean. Momentum and defensive can mean different things at different points in the cycle.
100%. I'm glad you brought that up as well. And, if I'm reading between the lines, passive is always going to be, it's not going anywhere. I mean, I think
No, it's
the
not.
market's embraced it. But, if
Yep.
you think about some of the things you're saying, I mean, I've never in the 17 and a half years I've done fast money, I don't think I've ever used the term stock pickers market because theoretically, I mean, that's what it always should be. But
It always is. Yep.
what I'm hearing is, there's going to be a big place for active investing over the next 4, 5, 6 months, through the election and into next year, which I think is a pretty good sign, which if you think about it, might give some rise, not in a meaningful way necessarily, but a rise to volatility. That's just my 2 cents. On June
No,
17th,
I think
no,
that
go
that
ahead.
is a factor. And look, we're already seeing it. The rise in terms of growth rate of assets in and creation of even in the ETF world of active ETFs. And I think that's a sign of the at least the near term future. And to your point, that doesn't mean active over passive. It just means a more level playing field for providing opportunity for active, where active just got left in the dust for a long time. I just think they're now operating on at least a little bit more level of playing
It,
field.
it certainly appears that way. And again, I was just going to say on June 17th, you put out a really interesting note and it titled AI Hype is Supportive of Stock Valuations, but Cracks Are Emerging Elsewhere. Speak to that.
So, the valuation problem is obviously very concentrated in those names. But given the until the last week and a half, the dramatic underperformance elsewhere, it really opened up a significant valuation gap where if you just X'd out some of those mega cap names and the sort of AI focus there have been opportunities that have come out of that. And when you have, the average member drawdown of 40% in the NASDAQ, that breeds opportunities. And as it relates to I think one of the shifts, and we wrote about this a bit more last November when we did the full year 2024 outlook, that there appeared to be a shift from just the infrastructure of AI, kind of the creators of AI infrastructure, to AI representing something broader and who's utilizing it. It's almost like, the internet in the late 90s was about the infrastructure of the internet. Now every company's an internet company. You could say the same thing about cloud computing. Initially, it was the creators of it, the infrastructure of it. Now every company is a cloud company, and I think that's the shift that is underway in terms of AI's influence on market behavior, on performance, on leadership, and on valuations.
Potential risks that the market has that people are not paying enough attention to. I know you've done some work on that as well.
Well, I'd say right now the market is obviously expecting the Fed to start to ease policy in September. I think a dramatic shift away from that view, maybe because you get another spike in inflation. That's not my base case by any means, but you talk about risks that are not being anticipated right now. That certainly could be one of them, and I don't think the market would take kindly to another, spike like we saw earlier in the year in inflation that then caused expectations around Fed policy to have to kind of backpedal. Because you remember, it was only a few months ago that there was maybe some concern that the Fed would have to hike. Getting closer to the election, if there is immediate changes in terms of things like tariff policy, if something was established where that trajectory for inflation starts to go in the other direction. And again, it changes the reaction function on the part of the Fed. I don't think that that's built into expectations. On the other side of that would be a much quicker and more severe deterioration in the economic backdrop, which, if that triggered the Fed needing to move more aggressively, I don't know why there are people that think that that would be a great thing for the equity market. I think a Fed that is not moving slowly when they start to ease policy, a Fed that would have to step in and be really aggressive and sort of eye the elevator down instead of the escalator down, I don't think that would be good for the equity market because it would suggest much more economic turmoil. And if you look back at history, and we've only had 14 full Fed cycles in the history of the Fed, but there is a big difference when the Fed starts cutting between what the market does and where leadership resides when the Fed is moving quickly, meaning cutting aggressively, ostensibly because they're battling a recession or a financial crisis, or maybe both in the case of '08, versus a Fed that can act a little bit more slowly. So I always say be careful what you wish for. If
100%.
you want the Fed to just go full bore on the downside with interest rates, what they would be reacting to, at least initially, is not a good backdrop for the equity market.
No, Lizanne, you took the words out of my mouth again. I've said it on our podcast. I've said it on the show. Be careful what you wish for in the form of, wanting these Fed to act sooner. My instinct suggests that the longer they can wait, the better off we probably are, because that suggests that things are moving along somewhat swimmingly. And to your point about be careful what you wish for, I mean, if they were to move in a dramatic way, it's probably because something is breaking along the ways. And I think, and you know this a lot better than I do, but 1995 is that period of time where people look to and say, the Fed was able to thread the needle. Outside of that, not so much. So we'll see. I mean, I will say, and that's why we wanted to have you on for the second half. As interesting as things have been, I think it's going to get much more so, into December, January of next year.
I agree. And I think, from an election perspective, volatility could also be heightened and I suppose you could argue we don't officially know the candidates are, but yeah, I think any kind of really narrow election result and it's contested, then I think you've got a big volatility driver post-election day. There's still a lot of time between now and election day, and a lot can happen. But I think there could be volatility if it's driven by the election that is not just in the lead into the election, but in the immediate aftermath of the election, depending on what the outcome is and how tight the outcome is.
Yeah, and the correlate, people go back to, Bush Gore, I guess. You can go back to 2020. I mean, there's so many things out there. And again, the market's been the resilience of not only the market, but to a certain extent the economy as well has been extraordinary. We'll see. I'm glad you brought up the unemployment rate from 3.4 to 4.1. Doesn't sound like a big deal. I mean, it actually is a pretty big deal, and we'll see
It is.
if it is, and we'll see if that trajectory continues, and at what point. I've said for a while, Lizanne, before we get out of here, I think whether they admit it or not, the Federal Reserve wants things to sort of probably cap out around 4.5% or so, and then they're probably sitting in the catbird seat. But there's an element of thinking they can control it that I don't necessarily believe is the case, because once that is in motion, it doesn't stop.
Exactly. The unemployment rate does not sort of bounce around at a relatively low level for an extended period of time. And that's sort of the irony in the summary of economic projections. Not that that's a policy playbook, that's just moment in time assumptions on the part of the members of where they think things are going to be. But if that is accurate, some sort of flat trend in the unemployment rate for basically a 2-year period of time would be completely unprecedented. Once the unemployment rate inflects, either from declining to rising or vice versa, it tends to keep moving. It doesn't tend to bounce around. And last month, not just with the most recent report, but last month, the unemployment rate ticked above its 36-month moving average. That's never happened other than in the beginning of a recession. Now, there are lots of things about this cycle that have broken precedent. So it certainly could be different this time. There's been a ton that's been different this time, and we've bucked those relationships in the past. But this notion of an unemployment rate that just could kind of bounce around in the low fours, that would truly be unprecedented because it does tend to continue moving directionally.
We're going to know a lot more, Lizanne. It's great having you back. I hope you come join us again over the next few months. You are, as I said at the beginning, in the Hall of Fame, and rightly so. So, Liz Ann Sonders, thanks so much for joining us.
Thank you for having me.